Hey guys, what is going on? Welcome back to the channel. Again, I want to thank everyone for all of your support on the channel. If you guys do like the content, if you guys do like the video series, feel free to like, share, and subscribe. And if you are a subscriber, make sure to hit that bell button to get alerts and updates on all new content posted on the channel. For today's video, I thought I'd go through what is a PE ratio, price to earnings ratio. There have been a number of inquiries on the channel, new investors, new viewers to the channel, wondering exactly what do I mean when I refer to a PE ratio. So I thought I'd kind of go through what is that metric, how is that metric calculated, what is it telling an investor, and then how do you use it to evaluate stocks, whether a stock is expensive or cheap. And it's a ratio I typically use on all of my stock selections. So let's kind of dive into what a PE ratio is. As you can see up on screen here, a PE ratio is a price to earnings ratio. It's one of the most popular valuation ratios used by investors. It's very easy to calculate. Simply take the market price of a stock, the stock of the price either at the current price or at a former price, historic price, divided by the earnings per share. So for example, if you want to do a current PE ratio, simply get the price of the stock, find the last 4 quarters of earnings, add those up, and divide that market price by that earnings per share for an entire year. That gives you a number. You can also do that as a historic number as well. Let's say you want to know the PE ratio of a stock in 1980. Simply get the price of the stock in 1980 divided by the total earnings for the 4 quarters in 1980. Do the same type of calculation here. Market price divided by earnings per share. It gives you a historic PE average that we'll talk about why you'd want to do that with a particular stock's PE ratio. So now that you have configured that particular number, what is that telling you? Well, it's simply telling you how much an investor is willing to pay for a company's earnings. So for example, if a company has a PE ratio of 10, we'll just do this in a very simple fashion. Let's say the stock has a stock price of $10. It has $1 of earnings per share per year. So 10 divided by 1 equals 10. And that is telling you that an investor is willing to pay $10 for every $1 of earnings in that company. If a PE ratio is 100, again, let's keep this simple. Let's say the stock price is 100. It has $1 of earnings per share for an entire year. That PE ratio is 100. You can see that stock is relatively more expensive than the prior. The investor is willing to pay $100 for every $1 of earnings in this stock, whereas that prior stock, they were only willing to pay $10 for every dollar of earnings. So a PE ratio utilized in this fashion gives you the value of a company, the value of a stock. What is an investor willing to pay for a particular stock? So what is that essentially telling you then? Well, it's essentially telling you that a PE ratio, the higher the PE ratio, the more investors willing to pay, the more valuable that company is. The lower the PE ratio, the less an investor is willing to pay for that company, the lower value that investors place on that company. So it's a way of evaluating a company regardless of the stock price. So if you had a stock that was trading for $5 stock price but had essentially no earnings, you'd simply have an infinite PE ratio. It'd be 5 divided by 0, or 5 divided by a very low number. It would be a very large number. Whereas a stock that trades for $1,000 may have $50 in earnings. That PE ratio will be much, much lower than a $5 stock. So even though a stock may seem more expensive by the stock price, 1,000 versus 5, that $1,000 stock is actually much, much cheaper than a $5 stock because of the earnings it produces per share. So that's essentially how you evaluate a company with the PE ratio. The PE ratio also lets you kind of get an insight into the company moving forward as well. Typically, companies with high PE ratios tend to have greater future growth prospects. So you can think of these as the Googles, the Apples, the Amazons. They have very high PE ratios because essentially an investor is willing to pay for future earnings. So whereas a company may have very low current earnings per share, an investor thinks that a company's future earnings will be much, much greater. So for a Google, for example, hypothetically, let's say today it has $1 earnings per share per year. The investor thinks in 10 or 20 years that may be at 100 or 1,000. So they're willing to pay much more for each share of stock, even with low earnings, equaling a very high PE ratio, because they think in the future it'll have very, very good earnings, and they're essentially buying the stock before that happens. So that's the whole idea behind growth investing. It's much more risky. There's no guarantee that a company's earnings will increase, but if they do, you'll make quite a bit of money on that growth, because as the earnings increase, the company's stock price will increase as well as more investors jump into that stock. But you had bought that stock when it had a very high PE ratio, very expensive, but over time that PE ratio will come down quite dramatically as the earnings per share in that company increase. On the other side, you have companies that are well established that don't really have lots of growth prospects in the future. So stocks with low PE ratios tend to have lesser future growth prospects. And you can think of this as, for example, Ford, Procter & Gamble, some of the very well-known blue chip companies, Coca-Cola, for example, that are very strong companies, companies that will be around for quite a long time. They're very safe companies to invest in, high-quality companies, but their earnings per share are typically not going to increase much moving forward. So they're strong companies, very valuable companies, but an investor doesn't think that stock price will go up because their earnings per share won't go up. So the PE ratio tends to be quite low on these particular companies. Again, these companies are solid companies, and these companies typically have a very good dividend yield. These are more of the dividend investor, buy and hold, conservative investor that wants to get into a stock that they know that the earnings will stay stable moving forward. The price of the stock won't dip down, unlike a growth stock. So a Google, for example, for every Google out there, there's probably 100 companies that failed. So there's no guarantee that those companies will increase their earnings moving forward. But companies like Ford, Coca-Cola, Procter & Gamble, for example, you can imagine these companies will be around for 100, 200 years because they're quality and very solid companies. So that kind of gives you an idea, the PE ratio, whether a company is a growth stock, more of a dividend investor, buy and hold stock that will be a very safe bet moving forward, less risk, but less reward as well. And as I've often said in my videos, risk equals reward. Growth stocks are much more risky. They will have much more reward moving forward if they succeed, but again, there's that downside risk as well. Whereas blue chip companies that have been around for quite some time are more stable, will have less growth, but again, less risk with that company. So that's kind of how a PE ratio is configured, how it is calculated, and then what it's essentially telling an investor. So how do you use it? Well, you need to have the PE ratio valued against something. So a PE ratio can value a stock by comparing a stock's PE ratio against a benchmark. So what are some of the benchmarks you can use? Well, you can use a stock's PE ratio, again, how valuable the stock is with regards to its earnings per share against the entire market. So you can take a stock's PE ratio and compare it against the average of a large market, whether it's the S&P 500, the NASDAQ, for example, or maybe a market segment benchmark to kind of see exactly how valuable that stock is. If the stock's PE ratio is much higher than the average, maybe that stock is overvalued. Another way of doing it, a little bit better way, is comparing that stock's PE ratio against the same industry or the same stock type. So for example, comparing Ford against GM. But you have to be careful because if you compare a Ford and GM against a Tesla, for example, you're comparing two blue chip companies, well-established companies against a growth stock. So you can't really do that either. You have to compare it against companies in the same market segment and the same type of stocks, blue chip stocks against blue chip stocks, growth stocks against growth stocks. And you can also compare a PE ratio against a company's average in the past. So for example, you can do this with Ford, for example. Is Ford overpriced currently? You can compare it to a prior PE ratio from Ford. Also take a look at its earnings to see if that earnings per share is higher than it was in the past. Again, considering that you don't think there's going to be a lot of growth in Ford, that PE ratio should stay about the same. The stock's price can increase over time as earnings increase over time, but the PE ratio should stay relatively stable. If it's not, you can basically say, hey, a company is overvalued if the PE ratio is above its historic average, or a company is undervalued if that PE ratio is under a company's historic average. Again, because price to earnings is kind of taking out the price of the stock with regards to evaluating whether it is expensive or not. It's really based on earnings. So as a company will increase over time, a stock may go from $10 to $20, but if its earnings is also increasing at the same rate, that PE ratio will not change at all. That's really what you're looking at. If that PE ratio is higher in the future, maybe that stock is somewhat overvalued. If it's lower than what it was in the past, maybe that company's undervalued and it'll be a very good value investing opportunity. So that's how I use PE ratio. Again, this is a very simple way of describing what a PE ratio is. You can use this in a much more sophisticated fashion, but the way I use it is using it against the market average, again, against the stocks in the same industry, individual stocks as well as index is of particular industries, and then comparing the PE ratio of a stock compared to what it was in the past. And typically this is good for stocks that are dividend stocks, well-established stocks, blue chip stocks, not growth stocks. You really don't want to be using it in that fashion with growth stocks. So let me know what you guys think of the PE ratio. Again, I just wanted to do a very quick review here. It can get much more sophisticated, but just wanted to introduce to you guys what is a PE ratio, how is it calculated, what does it tell an investor, and how can you use it to evaluate stock picks in the stock market. So let me know if you guys use PE ratio. Do you use it the same way I do? Do you use the forward PE ratio, trailing PE ratio? Again, there are a number of different ways in which you can use this PE ratio. I typically use all of those, as well as some other metrics, which I'll talk about in other videos. But again, for new investors, the PE ratio is definitely something you should know, and is a very good way, very easy way of evaluating whether a stock is expensive or not. So let me know what you guys think of the video here. Please let me know if I forgot to include anything that you would have included, things that are important for new investors. And not to make the video too long, I'll kind of end it here. Again, if you guys have any great video ideas, if you guys have any questions on this video, other videos, please let me know in the comment threads down below. I'm always looking for new topics to read up on and new videos to put out kind of based on what your guys' interest is. So please let me know in the comment threads down below. And kind of with that, I'll end the video, and we'll see you guys next time.